On behalf of the Advisors Forum, I'd like to welcome our members and their guests to our CPE series for CPAs webinar on Defective Grantor Trusts with Daniel Capobianco. Dan is both an attorney and a CPA, so he provides comprehensive tax services to his clients, which can include sophisticated planning as well as preparation of complex tax returns for high net worth individuals, business entities, and estates and trusts. His clients include both individuals and businesses that operate both internationally and domestically. Dan practices in Boston, Massachusetts. Welcome, Dan, and thank you so much for joining us today.
Thank you, Monica. All right, so this most comes to everybody's attention with the sale to the intentionally defective grantor trust. So we're not going to talk about that today because that's like a whole other topic on, actually selling assets and going through that whole process of selling an asset to a trust that's a grantor trust. Where the defective trust becomes important is in certain other situations pursuant to the sale. If you want to hold an S corporation, the trust has to be either an electing small business trust or it has to be a grantor trust and not to be a qualified shareholder of an S corp. There's other types of little trusts that can be shareholders, but that's where that would come into play. The grantor trust is supposed to take advantage of the disconnect between the income tax rules of the Internal Revenue Code and the estate and gift tax rules of the Internal Revenue Code. So that is kind of a historical anomaly that existed for a long time. And, tax practitioners picked up on it a pretty long time ago, somewhere in the 90s, and even though it existed prior to then. So the whole goal here is to create powers that will make it a grantor trust for income tax purposes. But at the same time, we want to keep it out of the grantor's gross estate for obvious reasons, because if it's going to land in the gross estate, we're not doing very good estate planning. So the grantor trust can be a grantor trust with respect to the grantor or beneficiary, but not both. And just as a quick summary, we'll probably get into this a lot more detail, is that the obvious person of a grantor trust is a grantor. I set up a trust. I retain certain powers. It's a grantor trust with respect to me. The income on that trust, it ends up on my personal income tax return. You've probably read in a lot of the literature things called the beneficiary grantor trust or the inheritance trust or a beneficiary control trust. So that's where you don't want the grantor to be the grantor. You want a beneficiary to be treated as a grantor. So the beneficiary grantor trust is actually in Section 678, and there is a conflict section in that that just says that if the grantor is the grantor, the beneficiary is not the grantor. So if you're going to be making something a beneficiary grantor trust, you have to make sure that you structure the trust properly so that there's no way the grantor is deemed the grantor of the trust. So then we have different little tricky language. The grantor trust provisions are in Section 671 through 679. And the statute is an interesting compilation of words. It's kind of complicated. There are exceptions inside of exceptions inside of exceptions. So sometimes the exception becomes the general rule. But generally speaking, the grantor is treated as the owner of any portion, which could include the entire portion of a trust for income tax purposes. So therefore, the remaining portion of the trust, which could be any portion of the grantor trust which is not treated, any portion of the trust of which the grantor is not treated as the owner, is subject to the normal trust tax rules. And that could get a little complicated from a tax preparation standpoint. So if you're preparing income tax returns for a trust that is only partially a grantor trust, then it's a little strange trying to run that through the tax software, because a portion of the income ends up coming out through what's called the grantor trust letter, which is not a K-1. It's just a letter that says this is the portion of the trust which should go on the grantor's tax return. And then the rest of the trust comes out as a K-1, which would be issued to other beneficiaries that are not the grantor. Now, a grantor can be treated as the owner of only a portion of the trust if the grantor trust power applies to only a portion of the trust assets. So just depending upon the power that's used, you could have the grantor being the owner of only the income, the corpus, or a fractional or pecuniary share, or even of a specific asset, and that's in the regulation. You know, I don't really jump into that because I only use powers, and we're going to go through a lot of these powers to make sure that we have a complete grantor trust, just to avoid strange income tax things, and it probably doesn't even work for estate planning. It just makes it too complicated. So who is the grantor? Well, there's no real definition of a grantor. Obviously, in the legal sense of it, a grantor is any person who creates a trust or who directly or indirectly makes a gift to a trust. So I could set up a trust for a client of mine and put $10 in it. I could be the grantor. But if the client puts $1 million into it, the client becomes the grantor, even though on the trust document, I'm the nominal grantor. Dan sets up a trust with $10. Yeah, I'm the grantor with respect to $10. Once the grantor or the indirect grantor puts assets into that trust, he or she would become the real grantor for grantor trust purposes. And here we go, because this comes up all the time where clients like to say, well, gee, I can't give any more money to my brother. Can I give it to my cousin who then gives it to my brother? Well, that's an indirect transfer. So a person reimburses another person who makes a direct transfer. That's an indirect transfer. And then a transfer is made by a trust or a corporation that is treated as a constructive distribution to the entity, shareholders, or partners. This is just thrown out there because some of this is what comes up. I see this in my practice. It's just kind of sloppy planning where there's a corporation involved and nobody wants to set up separate checking accounts, so they just write a check directly from the corporation into the trust. And so then you have to have make-believe transactions to try to follow the money and make sure that it's flowing correctly. Again, per regulation, if one trust makes a gratuitous transfer to another trust, the grantor remains the same. Okay, that's probably kind of obvious. If the transfer occurs pursuant to the exercise of a general power of appointment, the holder of the power becomes a grantor with respect to the new trust. And then again, the transfer is made by corporation or partnership for business purpose, then the corporation or partnership is the grantor. So that takes it out of the indirect transfer column. Again, last sentence, if the transfer is not made for business purpose, the indirect transfer rule applies. I like to keep things straightforward. These are like, I throw these out. I dug through the regulations just to put some of the different variations of the theme on there. And again, we have two big issues that we have to always watch out for whenever we do planning, and that's the step transaction doctrine and the reciprocal trust doctrine. We're not going to go there, but just keep that in the back of your mind, especially in today's environment, 2012, where you want to make mega trust gifts of $5 million. You do husband and wife. You want to do crisscross trusts. You have to be careful. One trust it just cannot look like the other trust because basically the IRS will just uncross it and then it'll defeat the whole purpose of even trying to do it. But there's a lot written on reciprocal trust, and I would just kind of direct you to that for further reading. So, defective grantor trust. Irrevocable trust, obviously, and it contains specific language intended to violate the income tax rules, but stay clear of the estate tax rules. So the grantor is taxed on the income of the trust, but the value of the assets are not included in the grantor's estate. So that's your classic setup. That's the basic foundation of any grantor trust planning. And here I'm just quoting the statute, just because it's always good in my brain. I always like to see what the statute says. And it just kind of, even though it's like a little convoluted language, it's always just good to see what it says. Essentially what you're doing is you have an irrevocable trust, so instead of giving the grantor a K1, you're giving the grantor a K1 letter, even though you have beneficiaries on the trust. And that's one method of doing it. The other method of doing a grantor trust is actually just ignore the trust. Just file just a blank return with a tax ID number. And then again, there are others out there that actually just completely ignore the trust, don't even get a tax ID number for the grantor trust. So we'll kind of touch on that in the end, because that's more of a matter of personal preference. I like to get tax ID numbers for grantor trusts and just file returns, because it just kind of gives a paper separation. Although in practice, a grantor trust is, in practice, an irrevocable grantor trust is really no different than the revocable living trust that we use. They're both grantor trusts, and either way, we're using the grantor's Social Security number as a tax ID number. When you do a separate tax ID number for the irrevocable grantor trust, what you're doing is you're putting that number on the Schedule E, page 2 of the Form 1040. It comes up with no income, and then individually on the grantor's return is where you would pick up the income. Again, that's more of a tax preparation issue. Not here today to discuss how to prepare an individual 1040, but it's always good to kind of see how this is going to end up flowing when all the smoke clears. And then, again, I've said this earlier, if it's not taxed to the grantor, then it's taxed within the normal rules of fiduciary income tax. So now, what we have to do is kind of go through the powers, because now we have to thread the needle. We want to make it a grantor trust for income tax purposes, but we need to stay clear of the string sections, 2036, 38, 42, because that will defeat the whole purpose of what we're doing, unless, of course, you really want to keep it includable in the grantor's estate. Or maybe he or she is not taxable, you're looking for a step up in basis, and so you're not concerned with 2036, 38, or 42. But by and large, this is, grantor trusts are used for high net worth planning, and chances are they're taxable estates. You don't really want the trust being pulled back in. So these are, and as we go along, we can spend a little bit more time on some and kind of just brush over others. But one of the most well-known ones is the trust income may be used, and the statute says, may be used to pay premiums on life insurance on the grantor or the grantor spouse if the person holding the power is a non-adverse party. We're going to talk about that. It's basically an independent trustee. Now, there's some, not some, but there are a few pre-1954 cases which question whether the power to pay premiums is enough. And, you have cases that, well, if the trust doesn't own any insurance, then that's not going to work. If the trust owns insurance but doesn't pay any premiums or whatever. But that statute had different wording than the 1954 statute. The way I read 677A is, or essentially is that as long as the power is in the trust, as long as the trustee has the power to take any income, whether you have income or not, and whether you own an insurance policy or not, that would make it a grantor trust. Now, there's a few commentators out there that don't agree with that. Certainly, there's enough uncertainty in it. I wouldn't put all my faith into that power, because the IRS could come in on an audit and say, well, yeah, technically it does say that, but in practice that's a hollow power, and I suppose the IRS could just, kick that down the sidewalk. Technically speaking, when you think about it, every single life insurance trust is probably a grantor trust. simply because if it's holding life insurance, then obviously the trustee has to be permitted to pay life insurance premiums, and chances are the trustee can use income or corpus to pay for insurance premiums. So just about every ILA is going to be a grantor trust. It's not a big surprise to me. It shouldn't be a big surprise to most practitioners. And actually, there are a couple of private letter rulings, not that they can be relied on as precedent, but there are a couple of private letter rulings where, the service actually, looked at the trust, and they just looked at it and they said, well, the mere power to pay premiums with income will make it a grantor trust. And one ruling in particular, I remember reading it. I don't have the site for you guys, but I can always email it to you. It was having to do with a foreign trust. I mean, the IRS wanted to bring the income into the grantor's onto the income. I'm sorry, get tongue-tied. The grantor's income tax return. So they wanted to take the foreign income and plant it on the grantor's 1040. So it grabbed the power and said, well, it can pay life insurance premiums with income, and we're going to make it a grantor trust. So what's our next one? We can grant a non-adverse party, which is not the grantor's spouse, the power to add beneficiaries, except after born children. So where this is used in practice is you make spouses, companions of descendants, ancestors or siblings, anybody that you feel may be a beneficiary, or maybe you want a beneficiary. This power actually comes in handy if you're doing estate planning for somebody who maybe doesn't have children. Although that's not going to fall inside of the grantor trust rule, it's still a handy power if you're planning for somebody who's single. You essentially make his or her parents maybe the current beneficiary, and then give somebody the power to add future beneficiaries if that, if it's not in there already. I'm not sure you can set up a trust that says for my children if you don't have any children at all. Most of the time I see this is I'm doing planning for someone, and the client, husband or wife, doesn't matter, or both, we have young marriages, and they're not really enamored yet with the in-laws, but maybe they're looking 20, 30 years down the road, assuming they're going to be alive then, and saying, if I'm still alive and my daughter's still married, then, maybe we can make my son-in-law, beneficiary. Just it's a level of comfort. Just the power to add a charitable organization is enough to make it a grantor trust. And that's a, quote, safe way of doing it, is skip all the stuff I said before it and just give a non-adverse party the ability to add charitable beneficiaries. And then this is more, again, back and forth, depending upon how conservative you might be. There are some that say that the person should also have the power to direct the distribution to this additional beneficiary. Personally, I add that sentence to my language. I say that the non-adverse party can add a charitable organization as a beneficiary listed in article such and such, and shall have the power to direct the trustee to make distributions of income or principal to this new beneficiary. And I'm pretty confident that that creates a grantor trust as with respect to both corpus and income, because I do that for S corporation planning. So here's one that's pretty common, and sometimes it happens by accident because people aren't really thinking about it. They just make the client wants his or her spouse to be an income beneficiary. So if the income or principal is payable to the spouse, the grantor spouse, without the consent of an adverse party, then that's going to be a grantor trust. Obviously, the grantor has to have a spouse in order to do that. So it doesn't work for single people. The power is a bit unreliable because we don't know what's going to happen with the spouse. The spouse could always die before the grantor. Interestingly enough, though, you make the spouse a beneficiary and then the client gets divorced, it's still a grantor trust as long as the spouse is alive, even though the spouse is now not the spouse. So if the spouse is not, the spouse is not a beneficiary or a related subordinate person, spouse can have broad discretion as a trustee. Basically, name the spouse as a trustee, and that will make it a grantor trust. So that works also. Now, we're going to spend a lot of time talking about the next power, and that is the substitution power, because that's actually what just about all these trusts use. There's a couple private letter rulings that kind of bless this power. So, and that is the grantor's spouse, or some other non-adverse person has the power to reacquire trust property by substituting other property of equivalent value. The word used in the statute is reacquire, which kind of would question or raise the question of, well, if somebody who's not the grantor, somebody who didn't even put property into the trust, has the power to reacquire it, how can you reacquire something you didn't put in? The IRS doesn't seem to think that's a problem. There's other commentators, they don't seem to think it's a problem. And like I said, we're going to spend some time on this power. The grantor spouse, or some other non-adverse person has the power to borrow from the trust or to receive a loan made by a non-adverse trustee without adequate security. Now, you can also do it without adequate interest, because that's what the statute says. I wouldn't recommend it. There doesn't seem to be, let me take this back. I personally, and there's nothing that I've read that says you can't do it, is I kind of stay away from the grantor retaining the right to borrow from the trust, because it smells like a retained power. But there's no problem with giving the grantor spouse the power to borrow from the trust without adequate security, because under 672E, we have spousal attribution. So if the grantor spouse is not actually a grantor, but maybe is a beneficiary, and then you give the grantor spouse the ability to borrow from the trust without adequate security, but at the, let's say, the AFR during the month of the loan, then I think you've pretty much got a grantor trust without risk of inclusion in anybody's estate. Of course, you can always establish a foreign trust for the benefit of U.S. beneficiaries under Section 679. That's, in my mind, of limited usefulness. You run into S-Corp shareholder issues, and I just don't see a need for doing that, but I just thought I'd throw it in there because it's in the statute. And of course, we have to be very careful of these powers. These are just, some of these are like really, really obvious. So if the grantor retains the right to possess or enjoy transferred property, that's going to be in the estate. You don't want the grantor to be an income beneficiary. You just don't want these powers. There's no need to keep going through them, because these are the powers that we always stay away from. But these will cause grantor trust for income tax purposes. We don't want reversions. We don't want general powers of appointment, deemed or otherwise. We don't want the grantor to have an incident of ownership over an insurance policy transferred to a trust. That's Section 2042. When we talk about the rev rulings, you're going to see where this smelled like it was an issue for a while. It caused some strange language to show up in the substitution power in some of the form books I looked at. And we're going to talk about that in a second. And then, of course, if the grantor somehow or other had these powers in an irrevocable trust, and we pick up the trust and we say, well, we've got to make sure the grantor releases these powers, this is a 3-year window. This is a little application of the 2035 3-year rule. So if maybe by some bad drafting or inadvertent drafting, the grantor had a power that was going to bring the irrevocable trust into his or her estate, you can always have the grantor release that power. But then it's just make sure that you keep the grantor alive for 3 years, or you have 3 years worth of term insurance. So what we have here, these are the pretty much the big rev rules: 2008-22, 2011-28. I threw up Rev Proc 2008-45 because that had sample grantor trust forms in the charitable trust scenario. I didn't put this in there because everybody in the planning world seems to be familiar with this one, and that's Revenue Ruling 8513. But we'll talk about that for briefly before we go into these rulings here. Essentially, Revenue Ruling 8513 is cited, rightfully so, because the IRS cites it for the proposition that you can sell assets to a grantor trust, and it will be completely disregarded for income tax purposes. This is like one of the cornerstones of the sale to the defective grantor trust. This ruling was also cited by the IRS recently. I think it was a private letter ruling. Actually, it could have been a published ruling too, on selling an insurance policy to a grantor trust, because they were trying to get the insurance policy out of the estate, and they put it into an ILET. You didn't want the 3-year rule to apply, so the whole idea was to sell the policy to the grantor trust. So under 8513, any sale is just disregarded. The extension of that rule, obviously, is if the trust pays interest to the grantor. It's not deductible by the trust. It's not income to the grantor. And in Revenue Rule 8513, it was actually an installment purchase for a note, closely held stock, and a Clifford-type trust. This is like going way, way back. This is 30-plus-year-old ruling. But the principles are still the same. And so it's interesting to know, I mean, this had to do with a borrowing power. And so the grantor is borrowing from the trust until repayment rendered it a grantor trust under 675-3. So, you know, again, you can actually turn grantor trust power on and off by just having the grantor borrow money from the trust. And as long as there's an outstanding loan during any part of the year, then it's a grantor trust during that particular year. You know, 8513, I think, is always good reading because it just kind of walks you through the analysis. It's not really, you know, it doesn't really add anything new to what we have, so I didn't really put it up. The really big news was 2008-22 when it came out initially, because it essentially walked through the substitution power. It cited the Jordahl case, and it kind of put a lot of rest to some discussion as to, you know, how safe was the substitution property. So, and then what happened is the 2008-22 mentioned 2036 and 2038, but it didn't mention Section 2042. Although the Jordahl case actually had to do with a life insurance trust. So, you know, there was some discussions out there in the literature where it said, well, 2036, 2038, no-brainer. But what about 2042? So if the grantor has the power to reacquire trust property, then theoretically the grantor has the power to reacquire an insurance policy. And then now the grantor's got the insurance policy, and that constitutes an incident of ownership, even though the grantor never exercises the power. Well, I never really was that scared off, but the fact that people are writing about it in the literature all of a sudden creates an issue, because the IRS reads the same stuff we all read. But the analysis really, that doesn't make a lot of sense, really, because if you have a valid substitution power, the requirements of a valid substitution power is you give fair market value. So if the grantor, and I don't know why you would do this, but if the grantor were to buy the policy from the trust, the grantor would have to give fair market value for that policy, whatever the fair market value is on a life insurance policy. But now the grantor has the policy back in the grantor's estate, which that's where it's going to be if the grantor dies. So the concern really was that the mere existence of the power of substitution, if it included the policy of insurance, might cause inclusion of the whole trust. So, I saw some language in a lot of farm book trusts where it would say, grantor has the power to reacquire property, parenthetical, except insurance policies owned by the trust, close parentheses, blah, blah, blah. Well, 3 years later, and I'm not really sure what took the IRS this long to do it. Maybe they were studying it for 3 years. But they came out with 2011-28, which basically is the mirror of 2008-22. And same logic, same reasoning, but it includes 2042 as a power that will not be triggered by the existence of this power. So what did 8-22 and 11-28 say? Well, it says the trustee must have a fiduciary obligation, either under the trustee instrument or local law, to make sure that the grantor's compliance with the terms of the power by satisfying itself that the properties acquired and substituted are the same value. So guess what we put in our trust? We put that language in there. The substitution power cannot be exercised in a manner that can shift benefits among the trust beneficiaries. And what does that mean? Well, it means that the trustee has both the power under local law or the trust instrument to reinvest the trust corpus in a duty of impartiality with respect to the beneficiaries, or that the nature of the trust investments or the level of the income by those investments do not impact the respective interests of the beneficiaries. And then it throws this one in there, and this is about it. This is a throwaway, I guess. If the trust is administered as a unitrust. And then the last sentence is what we see all the time. Trusts, when distribution from the trust are limited to discretionary distributions of principal income. So, I mean, pretty much we have all this covered in our documents. So what I did was, I mean, the language is a little cumbersome. It's, again, these two rulings, if you're going to do defective grantor trust, you should read them, understand them, look at the IRS logic. But pretty much, for lack of a better word, it created a safe harbor. So when we draft the power, it's got to be a non-fiduciary power. It's got to be without the approval of a fiduciary or without the approval of anybody in a fiduciary capacity. The trustee has a duty to make sure the values are equal. The trust requires the power holder to certify in writing that the properties are of equivalent value. And this was a requirement, this was in the ruling itself, is the grantor cannot be or become a trustee under the trust. My grantors are never trustees of irrevocable trust. And I always put a sentence in, it's in Wealth Docs, that the grantor can never become a trustee under the trust. And of course, it cannot shift benefits. You put in the trust, we can't shift benefits. Now, interestingly enough, the IRS, and every year or every couple of years, the IRS issues sample inter vivos charitable remainder trust forms. They include sample charitable remainder trust, charitable remainder annuity trust, charitable remainder unitrust, and then the flip side of it includes sample charitable lead unitrust and charitable lead unitrust. Now, the sample forms that are issued by the IRS are presumably for practitioners to incorporate in their trust documents so that on audit, we can show the IRS, hey, I just used your language from Rev Proc 2008-45, so what are you complaining about? So the trust actually, they're complete trust, but they're incomplete. I mean, they do the job, but they don't have nearly the stuff we have in our trust. But the interesting point, and the reason it's in these materials, is because in the IRS sample language that's in these trusts, the substitution power is what's used to create a grantor charitable lead trust, which when you do charitable lead trust planning, sometimes you want to make it a grantor trust because what you do is accelerate the charitable tax deduction by virtue of it being a grantor trust. Of course, what that means is future income earned by the charitable lead trust is now taxed to the grantor. But if you're invested in tax-free bonds or whatever, it doesn't really impact you. And grantor trust treatment on a charitable lead trust is sometimes used as an income deferral mechanism. So what you do is you set up the charitable lead trust, you make it a grantor trust, it accelerates the charitable deduction in the year in which, say, an executive exercises a lot of options. Get a big spike in income, and you could really use a big tax deduction. That's fine. You accelerate the deduction into the year of the income, and then, in later years, when the charitable lead trust is earning income, even though it's paying it out to a charity, there's no more tax deduction because you already accelerated it. Nevertheless, the interesting piece of this is that the substitution power was given to a third person. It was not given to the grantor. So, again, the reason it's in here is because this adds credibility to what the literature already kind of acknowledges, is that the grantor's spouse, the grantor's brother, the grantor's uncle, or whatever, or me, can have a substitution power. Here's a few private letting rulings if you want to just see the variations of the theme. Again, we can just read them here. The grantor's father had the power, the brother could have been given to a disinterested party, the power was given to a co-trustee, power was given to the spouse. Although I haven't read 9037 lately, but I'm not quite sure how that one happened. If it's a co-trustee, how can it not be in a fiduciary capacity? And this is all fact-driven anyway, because the IRS won't rule on whether a trust is a grantor trust anymore. So you have these powers, they're in the document, the trust gets audited, or the transaction gets audited, and the IRS says, well, yeah, you have the power in there, but we're not going to apply that because the facts and circumstances indicate that the power was held in a fiduciary capacity. There's no way to predict around that because it's an audit issue, and audits are a completely different world. If you get an agent that's not quite on top of the issue, you're going to have to start explaining all kinds of things, which is sometimes why I don't go crazy on trying to step out of the box. I mean, if the IRS issues a safe harbor, I stick with the safe harbor. 2004-64 is up here because, when it first came out, it sounded like, oh, great, this is wonderful. But then when you read the ruling, I'm not terribly impressed with it. But let's go through it anyway, because this issue came up in a different area, and I really didn't expect it to come up, and I wasn't focused on it initially. But what the revenue ruling says is that the payment by the grantor of his or her personal income tax liability by reason of the trust being the grantor trust is not in and of itself a taxable gift. All right, well, we kind of already knew that even before the ruling, because it was like, well, the grantor is paying his or her legal obligation. Section 671 to 679 says that the income of the trust, if it's a grantor trust, is on the grantor's 1040. So if the grantor pays his or her tax liability because of that income, then it's not a gift to the trust. So that's like, the old asset burn technique. When we do the sale to the grantor trust, we're going to have the grantor pay the tax. We don't want the trust paying the tax. But the other pieces of the ruling are sorry, I'm going to go back here for a second. I didn't put in the other pieces of the ruling, but the other piece of the ruling was that you could actually have a trustee pay the tax liability, like you can have the trust reimburse the grantor for the grantor's tax liability attributable to the income picked up by the grantor. In Massachusetts, there's a little strange little thing here, and maybe there's a few other states too, where there's an issue of if the trustee has an option, not a requirement, just strictly an option, of reimbursing the grantor for the grantor's tax liability, then the trustee has potentially the ability to discharge a legal obligation of the grantor. And there are those that would postulate that that means a creditor can go after that interest. So if potentially a grantor can attack something coming out of the trust for the benefit of the grantor, then you have a 2036 issue. I'm not sure if I buy into that completely, but to me it's enough of a risk that would be like, wait a minute. You know what? The whole idea of doing this is for the grantor to pay the income tax because we want the grantor to pay the income tax. So I don't even put the power in my irrevocable trust anymore that permit the trustee and the trustee's sole and absolute discretion to reimburse the grantor for any tax liability arising by income being on the grantor's tax return. Now, certainly, if it's a mandatory reimbursement, that's not a good thing to do because that's a retained right. If the grantor retains the right to be reimbursed for income tax liability, I would just plain not do that. Now we have definitions, which are very important in the grantor trust rules, and that is, who's the related or subordinate party? Well, these are them, which is pretty clear. And the definitional section of our documents pretty much spell this out. So we don't have to really concern ourselves with that. I mean, basically, a subordinate party is a non-independent person. And then, obviously an independent trustee is somebody who's not subordinate to that. Before I go further, I just wanted to see if we could recap here. And that is the idea of doubling up on grantor trust powers. And that is, which power is good to rely on? I mean, do you add the beneficiary one? Do you do substitute power, borrowing power? And I don't know, my kind of quick answer to that is I like to kind of put them all in there. Like maybe make the spouse or give the spouse the ability to borrow. Give the grantor the power to substitute assets because I think in light of these revenue rulings, we don't really have to deal with that. We don't have to worry about that risk. Don't give the grantor the power to borrow. I just no need for it unless maybe you want to do that for some whatever reason. But as long as the grantor is married, I would say it's probably better to use the borrowing power, to give that power to the spouse. If the spouse dies, well, that's one less power you have to deal with. Of course, the power to add charities, I think, is as safe a power as you can get. If you just leave it in there, and it may or may not ever be exercised, but it's belt and suspenders stuff. Beyond that, I don't like to use any other powers that it could remotely create an issue. So here we go back to our definitions. Again, this is like baked into the language of all our stuff. So we don't really have to pay a lot of attention to what the definition is, but it's always good to know what it is. Again, because questions come up. Well, can the president of my corporation be a trustee? Well, yes and no. It's not actually hard and fast. It's a presumption. But my philosophy is why go there? Aunts, uncles, nieces, nephews, stepchildren, in-laws are not related to subordinate parties. So that's kind of an interesting little twist. Not a lot of people realize that, but this is the class of people right here. Aunts, uncles, nieces, nephews, stepchildren, and in-laws are not related to subordinate parties. So if these type of folks fall into, if they're friendly and cooperative, then they would make good trustees if we need friendly, independent trustees. Now, what's an adverse party? Well, here's the statutory definition of it under 672A. So if you benefit from the trust, whatever happens is adverse to you. So that's kind of a strange definition. Basically, you're a beneficiary, either contingent or remote. So the exercise of the grantor's power has to affect the amount of income or principal received by the adverse party. Again, it's essentially a beneficiary. But an income beneficiary does not have an adverse interest with respect to retained power over principal, except to the extent that the exercise affects the income interest. So if we have a distinction between income beneficiaries and principal beneficiaries, you may have a kind of a weird analysis as to who's adverse and who's not adverse. And a non-adverse party is basically anyone who's not an adverse party. That's a very simple definition on that one. So you have to understand what an adverse party is, and then everybody else is a non-adverse party. Spouses. Spouses are good planning tools, whether you're in a joint tax return or doing estate planning. So any power or interest held by the grantor spouse is imputed to the grantor. And it's determined at the time of the creation of the power. So that's why I made that comment earlier, that you could have a divorced spouse and it's still a grantor trust, but the spouse has to be alive. Legally separated under decree of divorce or separate maintenance is deemed not married to the grantor. Here's an interesting one. If the grantor subsequently marries an individual holding a power or interest in a trust, the section will apply with respect to periods after the individual became the spouse. I haven't really seen this happen, so I guess keep an eye out for it, in case it does. Now, dynasty trusts. The irrevocable trust, we use the term a lot. It's in the literature. Just a couple of weird variations on the theme here. It's basically designed to span more than one generation. So, you have D.C. and Maryland with no rule against perpetuities. Maybe Delaware. Let's see if I can mention Delaware. But Virginia has a common law rule against perpetuities. Massachusetts has a common law rule against perpetuities. Most of the time we're doing defective trust planning, we're dealing with dynasty trust because we're trying to insulate the trust forever, especially when you're using the $5 million gifting. So the key here is that we want to make sure that we're properly allocating the GST exemption. So, and again, this is more of a tax return preparation thing, because we have to make sure that the GST exemption is allocated to this trust in the year in which we set it up. And I think, can we open this up for questions? All right. Any questions?
Yes, we do have some questions. The first question we have is kind of long, so if you need me to read it again. Okay. The first question is, you mentioned that most all ILITs will be grantor trusts because trustee needs to pay premiums on the life insurance policies, but if the grantor is hoping to utilize his or her annual gift tax exemption to make gift tax-free contributions to the ILIT to fund the payment of premiums, wouldn't it be better for the ILIT not to be a grantor trust? In that case, shouldn't the trustee be prohibited from using trust income to pay premiums to pay premiums, relying instead on new funding to pay premiums?
Well, yeah. First of all, the first issue is, do you want it to be a grantor trust or not? So if the goal is to not make it a grantor trust, then yes, you want to eliminate that particular power in addition to all the other powers that could cause grantor trust treatment. And then what you're doing is restricting the ability, basically what you're saying is that the trustee can only use contributions of property to the trust to pay premium. Did I understand that correctly? I mean, if the trustee is prohibited from using income to pay premiums on life insurance, then that power doesn't apply.
Yeah.
So, but as a practical matter, if you're going to tell the trustee, well, we don't care how much income the trust is making, you can't use $1 of income to pay insurance premium, then the only way you're going to pay insurance premium is from, contributions by the grantor. Which is nothing wrong with that. It's just if the goal is to not have a grantor trust, then yes, you eliminate that power.
So he's asking, in that case, shouldn't the trustee be prohibited? Is the answer to that yes?
Should, right?
Yeah, should it be or shouldn't it be?
Yeah. I'm saying if you don't want it as a grantor trust, then you have to eliminate that power.
Okay.
Just make sure it's not in there. And that power actually, I think, during the assembly process, there is a question that says, do you want the trustee to have the ability to pay premiums with income? In which case you would make sure that power doesn't get assembled.
Okay, great. Our next question is, can the wife of the grantor be the trustee of the ILET for herself for life, then children, and still be excluded from estate?
Yes, but if the wife is going to be, or spouse for that matter, if the spouse is going to be a principal and income beneficiary and also a trustee, then the spouse is an interested trustee. So you want to limit distributions to the HEMS, health, education, maintenance, and support. But there's no, in fact, there's like a really old ruling on this, where the IRS ruled that the spouse could be an income principal beneficiary as long as, and trustee, as long as distributions are limited to HEMS, because it's an ascertainable standard. It's certainly what I do. Okay. I don't give a spouse, if a spouse is a beneficiary in a trust, well, I don't give any beneficiary and trustee discretionary distribution power, because that's a power of appointment, general power of appointment.
Okay. We have, looks like, 3 more questions. The next question is grantor's CPA considered an employee under 672C? Please define who or what would constitute an employee.
Let's see. I'm going to go back to that slide. I'm thinking that employee is the common law sense, in that, CPAs are typically independent contractors, unless they actually are W-2 employees. Okay, so what we have is an employee, right? So essentially, what we would be talking about is the CPA of the corporation, of which the client has the requisite stock holdings. Is that the question?
It just says grantor's CPA. Would they be considered an employee?
I'll read into the question. I'll assume that the CPA is an independent CPA. Works for either owns a CPA firm or works for a CPA firm, and the CPA firm has tons of other clients, and this is just merely one client of the CPA firm. I don't think that CPA would be a related or subordinate person, because everything is terms of employees, and the independent CPA would not constitute an employee.
Okay. Next question. Virginia now allows you to opt out of the RAP. I guess that's more of a comment on your comment. Our next question, the year the Dynasty Trust is set up, if the Dynasty Trust is funded upon the death of a trustee in a revocable trust, is that when the trust is set up?
Read that one again.
The year the Dynasty Trust is set up, if the Dynasty Trust is funded upon the death of a trustee in a revocable trust, is that when the trust is set up?
I'm not sure.
Oh, sorry. She restates it. Yeah. The year the Dynasty Trust is set up, if the Dynasty Trust is funded upon the death of the grantor, is the trust set up when it's funded?
Well, yeah. I mean, this is the thing. You set up a Dynasty Trust in 2012, and you put $100 in it, and it's executed in 2012. That's when the Dynasty Trust is established. If it's funded by a pour-over from the revocable trust, if I understand the question right, really what you're doing is the assets of the revocable trust are going to be includable in the deceased estate. I mean, if it's not a taxable estate, then it won't matter. But all you're really doing is just pouring over the revocable trust into a pre-existing irrevocable trust. Is that what the question is?
I don't know.
But I guess the answer is yes, you can do it. I mean, you're not avoiding any estate tax doing it, because the only completed gift you're making is if you set up the Dynasty Trust while you're living. So if you, in my example, you set up with $100, then the $100 is out of your estate. If and when even when the grantor dies, and the grantor's revocable trust pours into the Dynasty Trust, well, the assets are going to be going into the Dynasty Trust net of tax. If
she sent in an answer. Thank you. I agree.
Oh, okay.
So you must have answered her question. So we have one more question that we can take right now. How do you toggle off grantor status?
How do I what?
Toggle off grantor status.
You can kill the grantor. Kill the grantor's wife. That's just being sarcastic. But yeah, when the grantor dies, if the grantor's spouse dies, but that's not really a toggle off. Toggling off would be the grantor renounces a power, or give the grantor the power to renounce any of the powers that the grantor has, which in my example would be the substitution power. The grantor releases that power, that's going to toggle it off. The method that's used kind of frequently is you give a trust protector the power to put the power, to reassign the power, so to speak. So let's say I'm the grantor and I have the right to substitute assets. I release that power, not a grantor trust anymore. But the trust protector has the power to make my brother, or give my brother the ability to reacquire trust property. Okay, cool. Now you can toggle it back on and off. I don't fool with toggle powers. It just, again, personal preference. But anytime you can, you really have to use a trust protector to do the toggling, I think, if you want to be remotely comfortable with doing it. I thought I read somewhere that that's on IRS's watch list as a reportable transaction, as toggling grantor trust status on and off. Not sure where I read it. I can't definitively answer it. Did that answer your question?
Well, that's all the questions we can take right now. Any
Okay.
questions, any other questions, and if you have questions after the presentation, please email us, and we will have Dan respond after the presentation via email. Looking ahead, everyone, the next CPE series call will be June 12th at 1 p.m. Eastern Time, when Stephen Bailey will discuss estate planning for business owners. Please check the events calendar on advisorsforum.com for information on other upcoming calls. Please now take a few minutes together to discuss this topic and to continue to promote teamwork in serving your mutual clients. Reassure your clients that their planning team is looking out for best interests. Being able to work together effectively and understanding strategies you can implement together is the key, and that's where membership in the Advisors Forum comes in. Please speak to the member who invited you today or visit our website at advisorsforum.com to learn more. Thank you so much again, Dan, and thank you everyone for your participation today. Have a great day.
Bye.